a session called What Investors Look For. I think you'll find it extremely interactive. I'm going to stop sharing in another 30 seconds. JP will pull up their slides. They'll introduce themselves. JP and Mahavir are good friends. JP will tell you a bit about himself. He also is the current president of TiE Atlanta. Mahavir has a lot of roles he plays in Rajasthan, across India, and then this year, and maybe even next year, he'll tell you he's the president of TiE Global. So with that, gentlemen, take it away. Thanks so much.
All right. Okay, so I've been teaching, not as long as maybe Paul, but I've been teaching about 16 years. So I know how to pick on people really good in all my classes. Because in the last 16 years, we went from no smartphones and not that many even laptops to everybody texting while they're in class. So I'm used to the whole virtual class session and trying to keep people's attention. But what I'm going to do, which I don't know if I'm sure you've gone through 1,000 different online courses by this time, is really ask you guys questions. So I look more from a case study method, which is getting you guys to tell us how you're thinking about presenting and thinking about these constructs, and then making sure that Mahavir and myself can fill in the gaps as we kind of go through it. So I want to call out on pretty much everybody on this list. Would love to hear what company you're with and which chapter or where in the world you are. So I'll go down my list that I've here, and I apologize in advance for constantly mispronouncing names in advance. So is it Sarai or Sarai? Are you there?
It is Sarai.
All right. Could you tell us a little bit about yourself and where you're coming from?
So I'm with LSK Technologies. We make a small portable device that can diagnose infectious diseases, and we are associated with Toronto chapter.
All right, fantastic. Shreyas? Shreyas there? I see you. There you go.
I'm Shreyas.
Can you turn your microphone volume
India.
up?
Okay. Is it
All right,
audible?
go ahead.
Okay, so I am Shreyas from India. We Clean Electric are working on electric retrofitting kits and platform on light commercial vehicle electric architecture. So our main focus is like to work on light commercial vehicles and to electrify it, as well as build some existing platforms for providing the solutions.
All right.
He's from Mumbai, and he's from Mumbai. Chapter.
All right, fantastic.
Yes, yes.
Aditya?
Hello, James.
Go ahead, tell us where you're coming from and what's
Sure.
the company and what's it about?
Sure. So James, we are from IIT Hyderabad, representing TiE Hyderabad chapter. We have co-founded Frings, which is a deep tech platform enabling high growth food and hospitality industry with state-of-the-art technologies. We are building a suite of products which will help them drive increase in revenues and margins. And we deploy AI and computer vision solutions to help them manage their operations, expand real-time hygiene monitoring, and curb the contamination risks.
Very good. Ankit?
Hello, hi James. So I am Ankit Joshi from Clean Electric. So we are from TI chapter Mumbai. So basically Clean Electric is working on some futuristic light commercial vehicles. So we are working on some electric truck, which must be a smart truck, just as our smartphones, with a greater performance and great reliability. So we are working on this.
All right. Did I call on Anand yet?
Nope.
Anand, are you there?
Yeah, I'm there. Aravind.
Go ahead, tell us where you're coming from and What's your company?
So we are coming from a place called Bangalore in India, and we are from Thai Mysore chapter.
Satish, he's talking about Anand Tiwari. Your turn will come. I think Anand, I can see you also.
Yeah,
Anand.
yeah. Anand is a chapter leader in Denver. I don't know if his team has joined, but Anand, maybe you can still speak for them for 20, 30 seconds.
Sure, yeah. So I'm from Thai Denver, and the company we selected here is One Kind Cup. It's if you see a regular cup at Starbucks, you can recycle the cup part, but the lid and the straw still goes to trash. So they're trying to target that problem, and they want to solve that. So they have a cup which comes with a paper straw, all in built, one package. You use it and then throw it. It's biodegradable and all that cool stuff. So that's the problem they're trying to solve.
Very cool. Ankit? Did I already called Ankit?
You know what? If you want, I'll go around the screen for you. Up to you.
No. I've got the list. I mean, I'm literally looking at the participants and I'm calling them in order, so on my screen. Go ahead, Ankit. Did you already speak?
Yeah, he already went.
Okay, Sharik?
Yes.
Go for it, Sharik. Yes.
Cool. So I'm the founder and CEO of Ambi from Thai Silicon Valley. Ambi helps small businesses legally play licensed music in their stores. We are the only platform on the market that is free forever, and we integrate with the existing ecosystem in the store to gather vital business data and use that data to lift sales 9% by playing the right music and playing the right messaging in store.
All right.
If you didn't notice, you got to listen last week to Vikash Shah's class on how to tell everybody anything while the elevator is going from the top floor to the bottom floor.
Perfect. Devinish, are you there? He was there earlier. Dharmya?
Yeah.
Dharmgya.
You're going to need to unmute. Yep.
Yeah. So I am also from the team Franks. Hello.
Go ahead.
Go ahead.
Yeah. So I'm also from the team Franks. So we are targeting the most inefficient industry worldwide, which is the food service and hospitality industry by McKinsey, and we are trying to make money from making that industry efficient by our suite of products, which is the tabletop ordering services, tabletop ordering system, the restaurant management system, and the Hokey. Hokey is basically the food safety and hygiene monitoring system, from which we take the live CCTV feed and we run our AI and machine learning algorithm on it, and we give them the results.
All right. Hardik?
Yeah, hi. I'm Hardik, founder CEO of Solar Critics, which is a crowd investing platform for fractional tokenized ownership of solar panels. We are representing Dubai, a Thai Dubai chapter.
All right. Let's see, is Manan, are you still there, or did Manan leave? Manan was in and Manan is gone. Okay. Omar.
Hello. Omar representing Radom, Thai, Oregon. We're building a platform to bridge parking providers with commuters, helping parking providers manage their facilities and helping commuters get directed to an exact parking spot so they don't have to look for it.
All right, fantastic. Prashant, you still there? Prashant is no longer there. Okay. Livia.
Hello, I come from LSK Technologies. I think Sarah already did our company pitch.
All right. Somebody got some background noise. Thank you. Is Jay still there or did Jay leave? Jay Rana.
Yeah, I'm still here. I'm from the New Jersey chapter. I'm part of Team Volant, and basically what we're trying to do is create a mesh network of drones to extend drone connectivity over a long distance for military applications.
Very cool. Praveen, still there? Praveen Yadav.
Yeah. Hi, I'm Praveen from Team Clean Electric, and we are building electric vehicles which will be more reliable and will have better performance. Basically, we will be saving the fleet owners and drivers a good amount of money, around 20 to 30% savings. And I am from TIE chapter Mumbai.
All right, fantastic. Satish, are you still there? Satish?
You're on mute, Satish.
Yeah, I'm there. Hello.
Yes, we can hear you now.
Yeah. Actually, I'm Satish Aravind, and I'm representing Last Triple, and we are coming from Bangalore, and we are from TIE Mysuru chapter. So, talking about Last Triple is nothing but we plant trees in memories of each pet which is there in Bangalore. Being a major pet centers in India, Bangalore, Hyderabad, Mumbai, and Delhi are being the major pet center. So we are confined our operation to these 4 cities as of now, and we plant trees for each pet's death with their name on it. If for example, say a pet named Alexa died, and we will plant we'll plant a tree in the name of Alexa in a place called Kabban Park in Bangalore. And we have planted about 150 plus trees, and as a proud volunteer, I'm happy to represent here. Thank you.
Awesome. Thank you. Sean?
Hello, everyone. I'm a representative from Radom. We're coming out of TIE, Oregon. We're bridging the gap from commuters to parking facilities to provide insight on available parking at your next destination. We're a B2C and B2B startup, so we're helping businesses increase operation and financial forecasting, along with commuters to lower their commute time.
All right. Sharik? Sharik, I think 2.
It's his phone, his
phone and laptop or something. Sharik, are you there?
Yes, I'm here.
Go ahead.
I believe I already went.
Team Ambi, Silicon Valley.
Yeah, I already went.
Okay. I think what threw me off is I had your name twice on this list here on Zoom. So my apologies for that. No problem. Let's see. Sushant, are you there?
Yeah, hi, James. Am I audible?
Go ahead.
I'm from IIT Clean Electric, and TIE Mumbai chapter. So we are currently making electric vehicles.
Okay, Tushar?
Yeah, I'm from the same team that Sushant was in, from the Team Clean Electric. So what we are doing, we are retrofitting diesel vehicles and converting them to the electric ones. So basically we are going at twice the speed, like eliminating diesel vehicles plus adding electric vehicles. So that's why we are retrofitting instead of manufacturing from scratch.
All right. Victoria?
Hey, I'm Victoria from Aerodyne Technologies. We're based out of Atlanta. And our product is an aerodynamic improving device for tractor trailers so that fleets can save money on fuel.
Very cool. Akash? Akash?
So, yeah, I'm also from the same team, Clean Electric, and we are building electric trucks along with the charging infrastructure to provide a turnkey solution to the fleet operators and businesses.
All right, Lauren?
Yeah, I'm Lauren Barnes. I'm from Tide Denver. My company is One Kind Cup, which is a one-piece disposable compostable cup, straw, and lid combination.
All right. So I went through and I know a few people jumped on and jumped off while I was actually going through this list. Did I miss anybody? I know also David Smith is your coaching, right? Could you maybe give a quick intro?
Yes, I'm David Smith. I'm a mentor for Raydam, and I'm at the Thai Oregon chapter.
Awesome. Did I miss anybody else on the list? Anybody else out there? Well, that was a good start. I think like it's always fun to hear what's your first pitch and how do you pitch yourself. And we're going to be going through that a little bit. Let me get my screen shared here.
And all
Can you guys
these
see my
slides
screen?
Our slides are in the shared folder, so you can access them later.
Perfect. Can you guys see the screen?
Yes.
Yeah, we can.
All right.
James,
So,
can I
Javier,
just before you introduce us, can I add something?
Please, please.
You know, just because the topic is what we are looking for, JP and I were looking at how you introduce yourselves, how you spoke a line or two about your process. Some people fumbled, some were very precise and to the point. You know, when you're walking in corridors, elevators, around pitch competitions, you just need, or writing a LinkedIn intro for one line. You have to practice this 2 lines, 1 line, 3 line to get my or get JP's attention. Don't think that you will get 20 minutes, 30 minutes or more. These 2 lines are as important for you to put a step into my office even before your pitch deck or your idea has any value. So practice this. You need to, and I'm sorry, but many of you were not up to the mark. Quite a few were very good, but I think you need to. So this is where your classes start right now, even before we're introduced. Very important these 2 lines are, and I'm glad JP did that. This is just to gauge what you were doing. Thank you, JP. Go ahead.
Well, I'm going to put it back to you, Javier. Could you give us your pitch? Who are you? Tell us, everybody, your background and your story.
Yeah, sure. So I'm Javier. I'm from Jaipur, India. I've been part of TIE for over 20 years. I'm a successful entrepreneur, and my motto has always been diversified businesses, diversified sectors, and I have succeeded in most of what I've done. Tech has always intrigued me, and because of TIE, I'm now a full-fledged angel investor without any technical knowledge or formal education. I can actually learn a lot about every sector, every domain, and I have been angel investing for the last 6 years. And I'm proud to have been part of TIE's mission to foster entrepreneurship, lead it in many roles, and now as the chair of TIE Global. And I look forward to angel investing and growing this sector from here thereon. Thank you.
Awesome. So you can see the screen and a few of my bullet points, and Javier is absolutely perfectly correct in his comments, because communicating who you are in a way that's impactful, but also shows humility, something that's an exciting story, that people want to join your adventure. It's all important how you communicate that. Now, I've written some stats here, which are all true, but it isn't what my story is all about. And none of us who are entrepreneurs, that's our story, our stats. I always say that's a symptom of it. Really, I am really good at what I call the living nightmare, which is getting the company from idea up and scale. And then I kind of like either relax or go do something else, and I get preoccupied to go back to my living nightmare of starting a new company. That being said, I love starting companies from from baby all the way to large, but I typically stay in the small cap sector and micro cap, mainly because that's where I think a lot of the value creation is one, exciting, and you can really put your thumbprint on whatever company it is. That being said, I'm going to tell you something that sounds odd, which is I'm not a fan of startups. What I am a fan of is what I call ventures. Now, a startup, in my opinion, is whenever I was getting started. You know, I had my first company, which was at 12 years old. The internet had just started, and I was a volunteer at my local library. And I said, nobody's using these computers. Nobody knows how to use the internet. I know how to use it. I like playing on computers. Maybe I could teach a class. So they advertised my class on learning how to use a computer to the public area. And we had students that came in from 40 to 83 years old. And that was my first taste of giving back and creating value and scaling it. So about a few months go in, and there's a lady, Wanda is her name, and she comes up to me and said, "What are you getting paid?" And I said, "I'm just a volunteer. I just am here to help out." And she said, no, go back home and find out, what does a person who does computers get paid? So I think I went back, and I think like some software developer at the time was like $60 an hour. So I said that, and I went back to the class. She said, it's a little too expensive. We'll figure something out. So a few weeks go by, and she ends up giving me an envelope. She said, just open this up at home. So whenever I opened up the envelope, it was $30 per person for the 1 hour class that I taught. The class got to about 30 students by the time I was in high school. So I was pulling in over $1,000 a week teaching classes. So this big aha came to me of, what is this concept of scaling value? And that's really what this whole process is about, of raising capital and how you can communicate that story of scaling that value. But for myself, I have built a whole bunch of different companies. I love what I call tech-enabled businesses, meaning companies that are old, that are archaic, that don't use a lot of technology. How can I add technology in there to automate processes, use data analytics to really capture intelligent value from the company that they've already got created, or for the companies that I've created? I've got one big company right now that's focused on consumer lending in the US marketplace, and we'll be scaling that out all across the world. But I've got a huge background in finance and capital markets. But I'll tell you, I'm really not the finance guy. I'm the entrepreneur like Mahavir. We get teams of people together that have that expertise to bring their expertise and kind of be like a conductor in a way, but we get our hands wet in everything, every single detail. And that's what I think is the most exciting part of this whole journey. Okay, so Mahavir, I slipped this whole slide in here right before I got online, but what I really want to go back to you guys is a Socratic approach. I want you guys to answer these questions for yourself and how to think through the psychology. So I know if you went to Blake Patton's presentation, I'm sure it was super detailed on institutional investors such as venture capitalists and how they're looking at the process. And there's a lot of similarities between this presentation and that. But what I want to do is have Mahavir tell a little bit about how his perspective was in this whole process and how we've both been able to approach it. So Mahavir, I know you've got a whole bunch of different experiences in different companies. So can you tell us about maybe one of the companies that you got started did you raise any angel capital? Did you get any friends and family to invest in you? How did you get that initial amount of money for maybe one of the companies you could tell us about?
Basically, when I started early, about 30 years ago, I had zero capital. And, the only way to go forward was to get financial institutions to fund you at that point in time. But without collateral in India, that was virtually impossible. So my only way to have some traction and to make a point that I will achieve what I will in the next 1 year, I had to actually borrow money and take, pay interest on what I was paying. But the key thing that I did was I wanted my operation cost to be less. So I said, I can't afford to pay you this high in interest rate. Can I offer you a lower interest rate and an upside? If I make profit, I give you more of what I can. And that's what I gave. And I gave them a stake. So it was an initial stage of a venture investment kind of a thing that I had initiated back in the early 90s, late 80s. And that is what has stuck with me. That first investment that was made, obviously, he ended up making a lot of returns, but the entire sectors that I have grown into, I have invested into people, I have invested into what their experiences are, and I have put in the money for what they have put the hard work for. And I feel that that's the most critical thing, and that's my experience that I come from.
Fantastic. I'll tell you about my latest company. One of the companies is called Leap Credit. It's a consumer lender. And, I remember one of my employees very early on said, why everything seems so easy? Why is it so easy to build this company and raise the capital? Those of us who had been doing it for 20 years plus kind of laughed and said, well, we went through this nightmare over and over and over and over again. And finally, after decades of trying and figuring out how to make this thing work, it seems easy. And that's really what a lot of people you guys need to understand, and what I need to understand, which is that you're not going to get it down perfect the first time. So a lot of it has to do with practice and consistency. So if you go all the way back to whenever I was just getting started, the first person I asked money for one of the investment companies that I was starting was my dad. Now, I really, if you know anything about, old school Indian dads who happen to be in the Navy, a little strict, and raising money wasn't really the thing to do, but he gave me a little bit of money. I think even to this day, he still asks, what percentage does he own? I said, I thought I paid you 3-5x long time ago. But that audience, your parents, your uncles, your aunts, your friends, I had an entrepreneur come to me, a young female entrepreneur. She said, hey, I'm trying to raise $500,000 for my new startup. And I asked, well, how much have you raised so far? She said, well, I really haven't raised anything. I said, so are you saying that you haven't put any money? She said, oh, I put, a few $100s in. Okay. I said, okay, that's fine. Now, have you asked anybody around you to put some money in? She said, no, I need $500,000 check. Well, I can tell you from personal experience, and Paul can tell you, and Mahavir can tell you, getting the check is not how you get the amount of money you need. It's talking to people that already trust you as kind of that first layer to give you a small amount of capital to get the ball rolling. And so much of it is just trust. And I'll tell you, Thai Atlanta, the entire Thai ecosystem, I wish I had this. I can't even dream of having this for my first companies, because the ability to create trust comes through consistency of relationship and how you treat the other people around you. Now, that sounds very obvious, but if you're going to be asking a person for money or a significant amount of money, have you been putting the time, effort, and energy into that person consistently? One, to build a relationship, provide consistency, show that you're going to be trustworthy and reliable, so that them writing an amount of money is not really a hesitation, because they believe in you and your ability to take that and create something from that. Mahavir, any experiences like that in any of the companies?
Yeah, exactly. So, I totally agree with what you were saying, JP. The idea, I really love it when we are being pitched for fundraising. And they say this idea is great. The market size is huge. All these slides show you the moon, and our growth for the year or two will be great. And then we say, okay, great. You need 500,000. Can you raise 50,000 from friends and family? they cannot do that, or I cannot. So if you are not able to sell the idea to the next person who's living with you for the last so many years, and you're telling me your ideas will be validated, will have the growth, will have the market, will get X percentage of the market size, it somehow throws us off the track. You have to understand many a times it doesn't matter if you can get money. It doesn't matter if it's 5% or 1% or 10%. It's the confidence that we see in you to raise that money, because every pitching will not lead you to investment. You have to pitch 20 places, 30 places before you get some synergy, because we as investors look not only at an idea that will succeed, not only at the team that will make it succeed, but also where we can contribute. People who are entrepreneur investors, as JP said, we need to sink in with the idea. We need to sink in with the team, that this is a team, this will work with us as entrepreneurs. No, we are not passive investors. All angels, all entrepreneurs, they are very active investors. They want to stay involved. They want to mentor, help, guide, and that's when they invest. So there's lots of synergy that has to happen. So what I'm intending to tell you is that if you can't sell your idea to your family, your immediate friends, your school and college mates, or not be able to do a crowdfunding of sorts, or do bootstrapping with all the co-founders for the time being, your chances of getting endorsement for someone you don't know are far lower than what they should be.
Absolutely. And let's see, one of the questions here, let's say that trust has already been established. How in depth should you go into the venture to potential friends and family investor? Great question. So with angels, high net worth individuals, ultra high net worth individuals, that's what those acronyms are, and friends and family, end of the day, they're probably not going to be the expert in your industry. They might be, and you might have somebody who is, has already successfully built a company in your space, which is ideal. You need to get those mentors, but more often than not, they may have no clue what it is that your business is. So much of it is learning who they are, what they're looking for, asking them questions to understand what their thesis is for investing before saying, hey, do you want to invest in my company? There needs to be an alignment with what you're looking for, who they are, connecting those dots so that there's a flow and a relationship that is being built over time. And that's the other thing. I literally cannot imagine how much money I've raised. I can't even put it in a pile. But the reality is, I know all the relationships that I've built, and I'm very consistent with it. So all of us have some kind of social media, right? Whether it's LinkedIn, Instagram, Facebook, whatever. So for not only my companies today, but the companies in the past, I've got this huge list of relationships. And the key is I am investing in them as much as they're going to invest in me. So somebody might have an interest for, playing golf or playing tennis, or they've got kids, or they've got, grandparents. Whatever it is that their life is, just like you would have any relationship, you need to know who they are and have a vested interest in their lives. So it could be, I don't know, if you go out and drink or eat dinner or whatever, inviting them as part of your life is how you build a relationship. And that's why I wrote that point. Investors are people too. Mahavir, can you tell me or tell us, have you built any relationships with any of the people you've invested in or have raised capital from outside of the business itself?
I mean, the networking is key. Relationship building is key. Whatever I think you, me, or Paul are today is because of the network that we work along, the goodwill that we have, the intent, how trustworthy we are, how professional we are, and how the use of words from being firm, authoritative, yet humble, focused, and aligned with what we are doing. I mean, all these things are traits that we need to have, imbibed in us. And that is what creates relationships. That is what creates trust. And I think all the investments that I have made or all the money that I have raised as a co-investor with other people has been based upon, oh, are you the lead investor? I would love to invest. That confidence only comes because of your track record, your follow-up, your intention, and all the other things that you've listed on this slide. They absolutely have to fall in line. Otherwise, you will be a lone person seeking investment or just investing or not being needed by the team that you have invested in. All three cases.
So that next phase, that was a great question, which is so much of it that initially what like Mahavir was talking about is more the relationship and them generally understanding the concept and the model and the pitch. They're not usually going to be a technical expert within your field. You should be the technical expert in your field. But when you start getting to a family office, it's the dynamics start to change. They're not going to be an institutional investor, and we'll get to that. They're not going to be super advanced, but they've got a pool of capital, typically with one or multiple families. Maybe they sold a business and they've pooled all their capital to write bigger checks. But this is where there's typically a manager involved or a financial institutional money manager that is going to start making some of the decisions on allocation. So you need to kind of know what that is. So Mahavir, can you tell us a little bit about what is a family office and how should we be approaching a family office if we're raising capital for our company?
See, I think what I feel, a family office or, having financial institutions reach out, you have to have a cohesive team, a cohesive family, technology, finances, compliance, operations, marketing, sales. That's what a family constitutes. If you look at a small family, every family member has a role defined. And similarly, your immediate family, which is your relatives and friends, and also the co-founders constitute a larger family. And this creates a family office where everything is comprehensive, everything is workable, and that's what's needed. So you really need to have your team in place, your support systems in place, and that's what would help investors give confidence in what you can deliver or the team can deliver. And that's what creates a very, very trustworthy relationship. JP, we can't hear you.
Oh, sorry about that. So I've worked with a lot of different sizes of family offices. So you've got family offices that may be small in the tens of millions, and then you've got much larger ones. I got to actually work with Vulcan, which was started by Paul Allen, who is one of the co-founders of Microsoft. That's measured in the billions of billions, tens of billions as a family office investment firm. So the size and scale and sophistication of a family office can widely vary. So just like Mahavir was saying, is the more sophisticated you are, the more sophisticated family office you can approach. One of my friends, he started a firm called Patstone. They've grown. It's a multi-family office manager. They manage, I think, 200 or 300 different families' money in a pooled investment type structure and money management. But they now have 7-8 billion under management. And so when we're pitching them different deals, the deals have to be institutional ready. But a small family office, I mean, I've got a good friend who played for the NFL, is a Hall of Famer, has made a lot of money. He has his own family office. He's got one small manager, but it's just his assets. So the level of sophistication is a lot lower, and the threshold is going to be more similar to an angel investment firm or an angel investor that I would be working with, more on the relationship side. That being said, you'll get into situations where your friend or your buddy who's the entrepreneur investor says, hey, go talk to my manager. So you go talk to their manager or the financial manager, and they're like, oh, well, you don't have all the due diligence, you don't have all the audit, you don't have all this other stuff. And what you want to do in those kind of situations is don't give up. Those types of individuals are there to protect the assets of that family, right? what you need to do is give them what you can, but you got to go back to the investor entrepreneur and say, hey, you know, I know you want to go through this whole process, but the reality is we're at this stage of the company. If you're excited about the company, look at investing a smaller amount with us and maybe a larger amount as we scale up. And that's where you can kind of bridge the gap. I've had to deal with that a lot over the decades. And it really makes a difference that you have a pretty strong relationship with the entrepreneur, regardless of the money manager who's going to make the yes, no type decision. Don't worry so much about them. They need to check their boxes. And that's just what their role is. Don't get intimidated and quit that's because of that process. Okay. Final thing before we take our first conversation with everybody is VC institutions. Now, you may have already talked with Blake. You know, Paul himself has helped start a VC fund. I have my own private equity institutional investments over the decade. And this is where it becomes a lot more formal. So Mahavir, can you tell us a little bit about what's smart money versus dumb money? And should a VC be in the smart money category, and who should you be working with?
I think smart money is always critical. I think I would take lower valuation. I would take lower money, but from a smart investor, whether angel or VC or institutional. I think your partnership or your investor has to be very, very smart, smarter than you, if that may be the case, as a team, if not as an individual. I think you know, you have a choice, and that's why where you need to understand what does your audience look like, what does an investor look like. Your research on the investment PE fund to VCs to angels has to be very, very critical. Is there synergy? Is there alignment? Is this person going to take you to the next level or the next round of funding? All these things are very, very critical. I mean, I would turn down any amount of money if it was coming from a person who's not, who's just a passive investor, who would not contribute to the growth of the company, who would not help me in the next round. It doesn't work for startups. You need to have smart money always, and that's the most critical thing. And no matter what stage or what level funding you are, but that's very, very important. You know, and I give this very famous anecdote. We are all born to parents, and we can't change them because destiny had that. But choosing a co-founder, choosing an investor is like choosing your brother, sister, or a parent. Investors are almost like mentors and parents. You have a choice in your life where you can choose your siblings and your parents, and that is where you have to be very, very critical. And they have to complement you. They have to be better than you. They have to be at par with you, and they should be, strong enough to take you to the next level. Otherwise, it will not help because you and them will be struggling at a later stage. That's what I've always felt, and that's what I think.
Mahavir sir,
yeah, go ahead.
Go for it, Akash. Go for it.
Yeah, Mahavir sir, I have a question. Like you, in your earlier comment, you said that if you cannot convince your family, then it is difficult to convince an investor. So I have a thought process that anyone should be self-independent and self-reliant. Why he needs the help of his parents when he is not confident enough to go to an angel investor or anyone else and convince him about his thing. So if I don't want to take, or any individual, if they don't want to take support from the family, they want to build it on their own, then is that a wrong thought process?
No, that's absolutely fine. So when JP and I say family or friends and family, we don't mean your father, your mother, your brother, your uncle, your aunt. What we mean is your immediate. So let's say if you were at a stage, at an idea stage, early stage, you have a prototype, you've tested it. Now if you come to me as an angel, I'll say, I want a little more POS, proof of concept. I want you to have a monthly growth, month-on-month growth, and come back to me in 6 months. Now, how will you reach there? You will have to go to someone locally, to an investor who's local, someone who's a referral, because he or she will invest because someone else is saying, or you will say that we will give you a 20%, 15%, 25% lower valuation in the next round of funding. Your ability to raise money from all levels is what we are testing, whether we're able to do that or not. And what you tell us, oh, I don't think my father will invest, or that's not what we are here. We are looking at, see, when we ask you questions, we know the answers. We are seeing how do you approach a problem? How do you intend to solve a problem? Whether you're able to do it or not is a different thing. I'm not taking money from my parents, let's say, but that does not mean that everyone cannot or should not. JP has. So what I'm trying to say is, and it's not about father, mother, chemistry between the family and friends. It's your intent and ability to raise small sums of money before you come for a larger sum of money. It is your energy, your confidence from within, your ability to do that, because come tomorrow where you are struggling, that is what's going to save you and me from that'll save my investment, and that'll save you your startup. That's what we are calculating and watching at that point. That's what I meant when I said that.
Agreed.
Understood, Mahavir, sir. Yeah, I think that helps answer my question, and it's a good way that in your past organization, if you're working in an organization and you have good relationship with senior executive, you can refer them. So that is the thought process which I always plan.
Absolutely. When we give you a certain name, we don't specifically mean that person. We're talking someone who's like that for you in your life.
Correct. Yeah, understood. Thank you, sir. Yeah.
Perfect.
Hey guys, quick.
Let me ask
question.
a couple of you. Hold on, just a second. There's a couple questions that came in earlier. Let me ask and answer those, and then we'll go to whoever's just talking. Okay, so Sharik had asked the question: does winning startup competitions count as money raised? So technically, yes. There are a lot of reputable incubators and accelerators that make a bigger difference than business plan competitions. For example, what's it called? Y Combinator is one of the most famous business accelerators in the entire world. It's based out of Silicon Valley, but it is definitely not for everybody. I think back in the day, you're basically living on their campus in their dorm, and you're eating, breathing, sleeping the business. And they're monitoring, and they're coaching, they're mentoring that whole process. So whenever they have their demo days, same with Techstars, same with a lot of these different foundries, I'm sure there's different ones around the world, there are going to be a lot of people that are going to be watching, because they know that these are the screened companies that have gone through their process. So an organization like TIE can definitely tell you, we have active VCs, angel investors, that are looking for deals, and those are the places that you want to go to, right? Because if you can get through their screening process, get in and pitch to the group, and you win the competition or whatever it is, a lot of real investors are going to be watching you for a period of time. I've seen companies, where 20 years ago, I wouldn't trust that person with 5 cents. But 20 years later, I've been watching them year over year build different companies, try, fail, and they've learned the concepts. So by the time that they got over to me again, one, they had a relationship, there was consistency, they had communicated, they had gone out of their way to get my advice and built a relationship over time. So whenever they ask, hey, I need $187,000 for my new company that I'm getting started, I put money in, we've got the proof of concept, and we've got the ball rolling. They presented at a program in Atlanta related to what's called ATDC, which is a huge accelerator here in Atlanta, Georgia, in the US. As soon as they pitched, all these people wanted to invest because, one, they had been in the community, they were being presented by a reputable organization as a winner of a competition, and they had a lot of people who were real investors. So definitely winning startup competitions are definitely key if you get legitimate VCs that are involved with the process or angel investors. The money itself just really depends on the structure of the win. So it could be a grant, it could be a convertible note, it could be a safe note. We'll talk a little bit about different structures, but a lot of it has to do with the reputation of that group. The next question was something or other non-dilutive funding. Victoria, are you there? Could you ask that question out loud?
JP, can I just
Sorry,
add?
I was just adding on to Sharik's question of like other non-dilutive funding like grants.
Okay, perfect. Go ahead, Mahavir. You can answer on that too.
So I totally agree with where you win, what you win, who the judges are, who's judging you. But also you have to understand that endorsement of any kind, is always good, whether small, big, or authoritative. Also, the confidence level of you and your team obviously gets, it's psychologically better for you to work. You work harder, you pitch more money, you pitch for more people, your confidence level gets up. So of course, I feel that winning startup competitions is always good. But of course, as JP said, depending on where you are, what competition it is, who's judging you, what the process is, very critical. Even on the non-dilutive funding, I mean, I think it's absolutely the same. If you get non-dilutive funding for now, which will be diluted later, or whatever that case may be, it's any sort of, someone who takes money out of his or her pocket to invest in your startup or in your idea or in your team absolutely is an endorsement. Whether smart or dumb is secondary. The fact that they trust you enough with their money, and despite having other options to invest, from stocks to mutual funds to other sources of investment, it is an endorsement. So anytime you're pitching or you have a business plan, you have been funded so much and so much, and that is an endorsement. Won so much. So it's absolutely not only confidence building, not only gives you a runway, in a short runway, but also builds your confidence and your team's ability in itself.
Next question was, so how do you balance investment from family and friends, even if that's considered dumb money? That was coming from Victoria. Great question. So I've literally raised over $500 million in what I would call dumb money. Now, I don't call the people dumb. I think they're very close friends of mine, but all that means is that they're not sophisticated experts within that space. So just like Mahavir said, I would 100% take an intelligent investor who knows my space that can help me scale up rapidly over any unsophisticated investor, because their value add is so much more. Their legitimacy to the organization, they are a stamp by themselves. For example, one of the most reputable investors in Atlanta, who's been around for decades, invested in one of my companies. I can then now use him as a reference, just like Mahavir was saying, to all my other investors. But because they've set the terms, the structure, the deal at the get-go, we wanted to raise a lot more capital. So what we did is we used that structure and that reputation to lead the deal. Then we backfilled tens of millions on that deal with unsophisticated investors, because that group of unsophisticated investors, who were mostly angel investors, high net worth, ultra high net worth, they weren't experts in our space, but because that sophisticated investor put the stamp of approval by writing us a check, that helped us backfill that capital. So there is a relationship depending on the type and stage of where you are and what you're looking for. Mahavir, any comments on that?
Totally. You need an anchor, smart investor. After that, I love dumb money. Dumb money is they don't ask questions. They go with whoever is leading. It's always great, but you need to have an anchor first. If you don't have someone who is the person that you need to grow, need to have the next round, all dumb money is waste. And it doesn't matter. There's no percentage. It could be 5% smart and 95% dumb money. It doesn't really matter. But that 5% smart money should be strong enough to take you forward. I would also like to, add on endorsements and to this money bit, that it's not just winning competitions. It's not just, getting money from friends and family or small size. It's also many other things. If you have failed 3 times as a startup, it's okay. You're far more stronger than an MBA for me as an investor. If you have raised money in your previous startup or have had an exit, it helps. All these are endorsements. This will help you get smarter money. This will help you get money. This will help you succeed. This is where confidence and trust and everything gets involved. But you have to be ready with the reasons. Why did you fail? What were the mistakes that you did when you did fail 2 times or 3 times or once? Who was the part of all the co-founders? I'm just, especially. So what you have to see, your roles, your team, and your analysis of what went wrong or what was right is very, very critical for me to get confidence in where you are. So all these are endorsements of sorts, and they help in one way or the other.
So we're going to skip a little bit forward, and then we're going to be doing breakout sessions here in a few minutes, and you're going to go through and take these bullet points, and I want you to pitch not only to each other, go round robin. We're going to have 4 breakout rooms, and then Mahavir and myself are going to be rotating through those rooms. So these notes right here, take this as you're condensing this whole pitch in your head for your company and your team. And we're going to do that in about 12 minutes. So I'm going to go through a couple of these points here. So just like Mahavir was talking about with references, I use my team as the reference. What does that mean? So I have been in so many companies and industries that I had no experience in. So why would anybody trust me to go build a company in an industry that I don't have any experience? Well, it has to do with I am really good at recruiting team, and not only just team, amazingly talented, seasoned team in industry that have already been through the phase that I'm in, meaning from if I'm in startup, if I'm in growth, if I'm in scale, if I'm through M&A. I recruit people as I'm getting to that stage so that whenever I talk to an investor, they don't have to talk about me. Yeah, I might be able to do a few good things, but really it's the team dynamics that creates that reference pool that Mahavir was talking about, so that you're bragging about your team and their track record and their experience, even though you may have none. Another thing has to do with just because you want to be an entrepreneur and start up a company doesn't mean that you shouldn't be getting a job to get experience. What I mean by that is a lot of the people that I've worked with and invested in, they had been working in that industry 5 to 10 years. So to some degree, they should have some sense of what the heck they're talking about, that I should be able to trust that they have the ability to execute from their idea. And that goes to this other aspect where there's a balance of being an expert in the product versus the business side, and they are not the same, especially during the phase that your company is in. I have worked with strategy consultants. I think they're some of the worst people to start a company, but some of the best people to help you scale a business. So just because you have experience in different industries doesn't mean that you're going to be good at getting the startup capital. You may have been used to big budgets, but do you have the sophistication or the team that can take you from the beginning stage as you scale? So one of our TiCon speakers in Atlanta, our keynote is Kabir Bardey. We have this magazine called Inc. 500, which is the fastest growing companies in the entire world and in the United States. And he was #1 with, I think, a 43,000% growth rate. He's a much younger classmate from Georgia Tech. But I was talking to him yesterday about his team. So early on, he had his idea. It's called OneTrust, if you want to check it out. And yes, he had been in the space at a company called AirWatch earlier that was in mobile device management security. So step one, he had experience and he knew the gap. Step 2, after AirWatch got acquired by VMware, which is a pretty big company, the founders from that company saw Kabir and his business and that he was serious about it in their space. And they actually invested and came on board to help him grow that company. You want to talk about greatest credibility, that the people who just have helped you investing and are going to be on your team just sold their company for $1.7 billion. And, you know, fast forward only 4 years in, Kabir's company is now worth over $2.5 billion. Why? Not because he was going to go and do everything. It has a lot to do with the team that you're building, business sophistication, product sophistication, and pulling that entire story together so that whenever you're going out to the market, you're ready to go. Mahavir, any thoughts and perspectives?
No, nothing to add. Absolutely agree with what you're saying. Great example.
Perfect. Last part on, you know, showing the track record and what the opportunity is. If you're going to ever talk to a VC or sophisticated investor, do not come to them with a small opportunity. That being said, if they don't believe that you can execute on a big opportunity, there's no point in you saying how many trillions of dollars of a marketplace that you've got available to you. So if you go towards any type of business that you want to get professional scaled capital, you've got to have a massive opportunity. The reason is those of us who invest like Mahavir, myself, Paul, a lot of other angels, we don't do all in on one bet. If you use the poker analogy, what we do is we spread our chips across a whole bunch of different bets, hoping that maybe one, maybe 2 out of 10 or 20 might work out to not only cover all the losses, but be much bigger. But in order to do that, you got to have a company that has a massive opportunity to be able to grow, scale, and have a potential massive exit or distributions or liquidity in the future from the investor's perspective. Now, you guys all know that, but if you can't connect the thesis of the investor with your thesis of the pitch, it'll never work out. Mahavir, if somebody comes to you and says, hey, I'm looking for $20 million, do you think you could invest that entire amount? What's the disconnect with them asking you that question?
Yeah, so I would never do that. And, you know, I would, you know, obviously co-investments, smaller ticket sizes, spreading our investments are a key. Moreover, if I had 20 million to invest as a single entity or as a group of investors who would invest behind me, I would start the startup on my own. I wouldn't need you. I would hire all of you. So you know, it would never work. So it's all from your point of view also. I mean, to having varied investors from various geographies, various experiences, various skill sets will also help you in the long run, because you can reach out to every individual investor, 5 or 10. It's always good to spread it out amongst. It's only on follow-on rounds. It's only pre-Series A or Series A that you should go to existing investors or large funding houses for that kind of money. At early idea stage, at angel stage, I would spread my investments. As an investor, I would recommend you spread your investors across the sectors, across geographies, across experiences and skill sets.
Perfect. So we've got 5 more minutes and we're going to start doing the breakout session. So get ready for that. So the last kind of component here that people are going to be looking for is the numbers. End of the day, this is not a nonprofit that you're building. You're doing a for-profit company. So people need to know what drives the business model for you to make money, right? Now, you all know that. You've all heard that. You've all talked about pitches and your, your financial statements and, what are the KPIs. You know this information, but the key is crafting a story. So that is a critical component. One of the things that I do that a lot of people find very confusing in the early days is whenever I'm growing, I try to grow consistently. Now that's very, very hard to do over a long period of time. What I mean by that is I try to upfront do as much as I can to figure out how this business is going to go, just like every investor is going to be looking at your pro forma, you need to be thinking what are the different assumptions that you have that are going to drive this business, and then carefully scale it up. So, for example, if you think it's going to go very, very slow, communicate that expectation so that the investor knows the perspective of time relative to your business. And it's okay that it takes more years to break even before your business scales up. Now, on the flip side, which is an odd problem to have, and one of my companies has this problem, is that we have a massive opportunity, massive growth potential, and we have the capital to do it. But we've been very consistent and careful so that there's not a lot of volatility in our growth, and we show nice consistency to our investors. Why is that important? That I would literally slow down our growth to have consistency over a long period of time. The reason why is any investor who's going to look at your numbers, your financials, your P&L, your cash flow statements, all these different metrics, they are looking for a reason not to invest more than they're looking for a reason to invest. Especially people like ourselves who do it consistently. I cannot tell you how many deals that I'm looking at on a weekly basis. To be clear, I'm an entrepreneur and I happen to do a lot of investing. But if I'm looking at 2, 3, 4, 5 deals a week that are coming my way, why do I want to invest in your business? Well, I need to look at a compelling story. I want to have a good relationship with you. I can trust who you are and that you can execute on this plan. And I'm not an expert in your industry. You've got to communicate the value, the ROI to me in a simple format that tells a story with data and information whenever it comes to these metrics. Mahavir, any perspectives and thoughts on this kind of data and information and financials that you present, and how we should think about that communication?
So, just for all your information, all smart angel investors, all entrepreneurial angel investors are very, very wicked people. And that goes for both JP and me. I mean, we're and when I say wicked, what I mean is that our questions are not straight, our responses are not straight, our comments are not straight. I have never had, even if I've loved the idea or the team, I've never sent them an email saying, oh, great idea, I want to invest. I will ask them 5 different questions. I will throw, curveballs at them. I would want to see the tenacity. I mean, you have to understand that we are just being a devil's advocate. What if when this thing went wrong? So we look for loopholes, we look for gaps, we look for how strong you are on the idea, on technology, or as a team to grow. We are looking to find reasons why we should not invest. So imagine critics who would want to fall in love with you, but and we are all poker face, to take the poker analogy further. We never get excited. We never show excitement. We can praise you because we're a mentor and wearing a tie hat, but as investors, we're as cruel as one can be. So you have to understand, and all our questions are not straight questions. Sometimes our questions mean something and we're just looking at something else. You have to really understand that so long as you're honest to the idea, so long as your team and you are able and capable to invest in the idea, so long as you and your team, irrespective of whether you get a funding from me or someone else, will continue to explore that idea and take that idea to public, a company that's listed on the stock exchange. If you are just looking to exit and make short-term money, trust me, we will come to know and we will find out. It's very, very rare, unless, and if you don't see the ability that you would be trying or working, we would not invest in you. You really have to feel it from within, and you cannot pretend to be what you are not. We will find ways and means. I mean, I've had great presentations, great market, great ideas, unique ideas. And I said, great. So what is the problem? You don't need me. Just you have a patent that's pending. I think you should just go to a financial institution, or go to a debt fund and get this for money for 1 year, because you have a great idea. You have 100% margin. You will make so much money that you don't need money in 6 months. And then they're like, what? So that's where, and then the debt funds will not fund you. You have to understand, you have to be realistic when you talk. You have to be realistic what you are. You have to be very, very fair to what you are, what your valuation should be. Not because you need 1 million and you can't dilute more than 10, 15 because the world has said so. So your valuation is 10 to 15 million. It doesn't work that way. Every number has to add backward, forward, top, down. We just go through everything, even if we go to a second or a third email situation with you. You have to understand we are making sure that our money is safe, and we are betting on you at this stage. So you have to be what you actually are, and we have to make sure that you are. And that's where what JP is trying to say is what we are looking at, and that will the only way that it will work for you.
Perfect. So we're going to stop there and do breakout sessions now, and we're going to still go through a bunch of these concepts for the next about 20 minutes. So what I'd like you to do, I know Amin and Paul is going to help with that, actually putting these rooms together. We're going to have 4 rooms. And what we're going to do is, I guess Amin or Paul, you'll be able to put the breakouts together. And then we'll have 4 rotations of 5 minutes. So we'll be able to go to each one of those rooms, and I'll be a timekeeper as well. So Amin, can you put those breakout rooms?
Yeah, it's on the screen as to which rooms they're going to, and we'll move you and Mahavir. You said every 5 minutes? Around?
Every 5 minutes. Yep. We just want to jump in. I want you guys to pitch each other's companies again. You've taken some of this basic advice Mahavir mentioned at the very beginning. I'm telling you, you got to practice pitching all day, night, every day of the week for the rest of your life, pretty much, to master the art form of pitching. So hitting some of those points, go through your breakout room, talk about what your company is, but hitting all those points, those 4 points that we talked about in your presentation to each other, okay? But keep it condensed, elevator style.
Because of the size of Clean Electric, I'm just going to ask them to be almost like 2 sides of the table, so I put them in one room. But otherwise, there's multiple teams per room.
All right, guys, the breakout rooms are open. Go ahead and enter into the breakout rooms as normal. You should see a notification on the bottom bar of Zoom. And once you guys are all situated in the rooms, we'll go ahead and add Mahavir and JP James into the rooms. And JP and Mahavir, to make it easier for me, because I don't want to move you in mid-conversation with any of the groups, if you could, when you get into the room on the bottom of
the teams is, when you're pitching, you got to know the concerns of the investor before even they ask it. And you have to address those concerns in advance. So it's so much about working and the psychology of working with investors is knowing the questions they're going to ask and the concerns they're going to have before they even have it, and addressing each one of those very thoroughly and consistently, that you drill in their head that you understand their concerns and that you've taken that into consideration. So we're going to wrap up here with a couple more items. I think somebody's not on mute. Satish, could you mute yourself? Looks like your mother is giving you food, or somebody's giving you food. Awesome. Okay, so a couple things here. One, capital structure, valuation, and terms. Now, there's this thing called Google and the internet. It has the ability to search for information. This is one thing I say to all of my team members. If you can't find it for the first 90 minutes to 2 hours on the internet, okay, I get it. But none of these items here, you can't find out the answer. There's probably 1,000 YouTube videos on explaining each one of these structures. That is not what I'm here to explain to you. What you can search on a dictionary. Well, they don't even have those anymore. I don't even think anybody has a dictionary. That's a whole nother conversation. But you should be able to know these terms inside and out. If you're an entrepreneur, I keep hearing this excuse, oh, well, you know, I need to spend all this time on building the business and not on the financials of the company or being able to pitch structure. I'll just let the attorneys do it. I will tell you, if you let the attorneys manage your deal for you, yes, either one, most likely the deal is going to fall apart. The things that you have to understand is, one, there are people on both sides of the table. They are not robots, and they are not attorneys and accountants that are negotiating this deal. The attorneys and the accountants are there to advise on the structure. You have to understand the concerns that they communicate, but more importantly, you need to know what it is that you're getting, for what value, and what is that utility to you. So if you're in a desperate financial situation with your business, one, it's already too late. But the most important thing is you always have to get ahead of the curve. So what I mean by that is, for example, in one of my businesses, the consumer lender, it requires unending amounts of capital, right? So if I knock on somebody's door today and I say, hey, can you give me the money on Friday? This is not going to happen. Unfortunately, the adage of it takes 3 to 6 months to close a deal is true. Now, as time goes on, it becomes easier. And that's where you've got to consistently build relationship. You got to consistently communicate. It is almost a full-time job. To give you context, when I started my latest company, I had 3 dedicated people just to help me with the capital raising process, because we knew that we were going to keep raising capital and it was going to be never ending. Now I've got 7 people dedicated on our cap team just to raise business. And that's not what our business is. Our business isn't raising capital. Our business is the technology for consumer lending. That's really our business. But the reality is you need to be an expert in legal, in accounting, in finance, and all of this nomenclature, but more importantly, building a set of advisors. The most amazing thing about TIE is you should have no excuse finding an accountant, attorney, advisors who are vendors to help you build out these components. Mahavir can tell you, even globally, all the TIE chapters, the number of people that can help you with this aspect to make sure you don't get screwed over in the process is very, very high. Mahavir, any thoughts and perspectives you can share about the TIE community? People can help with the structuring of the deal and how they can go about it?
I think you've nailed it on the head, JP. I think TIE's ecosystem is such that without having any intent to invest or to get any sort of sweat equity, we are great mentors. We have experience and knowledge behind us. We have experts in every sector. So whatever chapter you're close to, you can obviously reach to the Secretariat and to all the other senior members who can help you understand term sheets and SHAs and all these terms that JP has listed, even things that are not here like drag along, tag along, to multiple other things. That's what sweat equity should you give? Should ESOPs be important? The technical legal implications and terms are so huge, and even if you don't know this in depth, in detail, you need to know what they mean, what the implications are, what is good for you short term, what's good for you long term, what you can agree and not agree on. All these things are very, very critical. So you as co-founders need to know all of these things and many more.
Perfect. And like Mahavir said, you can be an expert on 90% or 95% of this. You miss one component, such as like preference or participation rights. You could literally sell your company for $1 billion and walk away with $0. I had a friend of mine who sold a company for $120 million, and he had 7 or 8% of the company. He walked away with 0 because of the original agreements that he put together for what would be the liquidating preference, basically the waterfall of how the cash would come out. He walked away with nothing. So you could get everything going the way you think is exciting, but you miss a single component on the legal aspect, on just the term side, or how you negotiate the cap stack or the structure on the far left side, understanding how the marketplace is. For example, lot of tech companies, fintech companies right now are getting pretty strong valuations because their ability to navigate the crisis that's going on globally versus if you're trying to sell a restaurant, probably not a good time, terrible multiples, and the valuation that you're going to get is going to be pretty hard. So understanding the future and based on where you are today is super critical. For example, when I started this last company, I was pretty confident that we were coming into recession in 2017. I said, we're coming into recession. We're not coming into quadrupling of the marketplace. So what we did is we actually got into businesses that were going to capture a recession, would do better in a recession. Now, right now, we're in the process of planning businesses that are going to do well in a recovery and scale up over the next 3 to 5 years. So thinking about how the marketplace is very, very critical. And a lot of that is part of you knowing the news. Now, this is not social media news. This is things like Bloomberg or Wall Street Journal or Financial Times. If you don't have a good global context and your local and regional marketplace context of what's going on in your space, on the macro factors, on the underlying economic factors, you're going to be negotiating always against yourself. Because if you're going right now into a retail business, you're trying to raise capital, you should know you're going to be getting pretty terrible valuations. So if you take a step back, look at the marketplace relative to where the deal is and the deal structure is and what you need, not just where you are and just looking at your bubble. Mahavir, any thoughts on kind of like maybe industries you've gotten into that are cyclical and timing raises and timing capital? How does that all equation have worked?
Yeah, so while on the breakaway rooms, what I did was I gave everyone 30 to 40 seconds to tell me about the company, about the competition and the challenges that they're facing. And though, the time was short and everyone exceeded from 30, 40 to 1 minute, but everyone just shared with me direct competition. They don't, you don't realize that there's so much of indirect competition, with Googles and Amazons and Facebooks of the world, shifting from one sector to the other, from one domain to the other, Tesla going from cars to commercial vehicles to other EVs. It's so easy for them to do that you don't realize what will come and hit you when you are, on the move. So many a times you don't realize, so staying in touch with sector specific news, staying in touch with sectors that could impact you are very, very critical. And you rightly said retail, food and beverage, hospitality, travel, all struggling low valuation sectors right now. But, always remember technology, deep tech, anything that you have, even if in these 4 sectors that are struggling, if you had AI, ML, SaaS-based models, you have a better odds of surviving if you were just as, unlike a service industry. Your roots into technology have to be very, very deep. Your intelligence, abilities to deliver solutions that are cheaper, faster, easier are far more critical no matter what sector you are in. And if you're not quick to deliver what you're talking about, you don't even know how many startups across the world, from China to San Francisco, are doing exactly what you're trying to do, and you will be left behind. The truck aerodynamics thing, you have to be very, very quick. Whether you have money, you want to be in an incubation center, or you want to have a grant for this research, you need to find funds quickly to deliver what you're talking about before someone else improvises, and so on and so forth. What I'm trying to tell you is having the knowledge of all these legal deal terms is one thing, but your embedding of technology deep-rooted and having multiple layers of technology, from machine learning to AI to aerodynamics to AR to VR, to have models in place, to have IP and patent, everything is very, very critical. The more barriers you create, the better it is for you, the easier it is for you to raise funds, not now, even follow-on rounds. never lose focus on that.
Perfect. All right, now it's next level of picking on everybody. So I'm just going to call out, and so I assume that you're going to make a mistake. Okay, so the goal with anything is to try, and we're going to collaboratively go through a lot of these questions. Okay, so let me pick on Satish. Are you there? I'm going to pick on the people who are not on video. Satish, are you there? All right, there he is. Awesome. All right, Satish, what do you think is a safe note? And where would you use a safe note? Can you say that again?
Can you repeat it again?
Yeah. What is a safe note and where would you use it? Everybody, you can use Google. It's okay to cheat.
No, yeah, safe note. Most probably in the situation to use safe note.
Satish, I think your audio is having some problems, or maybe your connection is having problems. So I'll give you a pass on that one. Not a problem. Does anybody know what a safe note is? All right, Sharik, go ahead. What's a safe note?
So I believe a safe note was created by Y Combinator in order to optimize and make making investments easier for super early stage companies. It is a form of convertible debt without interest, and it just, I believe it's like a 1-page investment document that pushes off the investment to a later stage.
That's a great summary. Great summary. You know, on the East Coast here in the United States, I really haven't seen a lot of safe notes. I've seen a handful, but it's a super flexible structure, very entrepreneur friendly, typically not done by any professional firm. But what it can allow you to do is when you're working with unsophisticated investors or with business accelerators, similar to like what you said with Y Combinator, they don't really want to set the terms on your deal. And they're really trusting your integrity that you're going to go and get a professional investor to kind of figure out what the structure is going to be. That being said, whenever you go into commercial marketplaces, Satish, could you mute yourself? Mahavir, can you tell us maybe a little bit, what are things that you've seen around the world of different types of early stage investment structures that are more common maybe in India or in the Middle East or other places that you've looked at?
Yeah, so normally when there's an accelerator like a Y Combinator, there's T-Hub in India and many others, that's a bit, so their expertise is not to value a company or to see what the company would be a year or two down the road. They don't want to take a risk. So they normally take this route where it's a discount investment route, which is a convertible debt, so to say. And it ranges from anywhere, Y Combinator, I think it's 15%, but it goes as high as 30%. A lot depends on what domain, what sector, what stage you're at. But that's what the next round, and how long do you take for the next round of funding? So I've seen funding in 6 months at a 15% discount, funding in 1 year at 20%, and so on and so forth, because the investor stayed invested for a longer period of time. So that kind of deals also happen, and it's easy, very convertible. And this also is good when you can't arrive, when the investor is interested in you and your team and your idea. You're interested in the investor to come on board, and you cannot arrive at a valuation because there's no examples from the competition or the sector. And this route is helpful in those situations, but this has to come when there is a stagnation in negotiations on valuations and where there's intent to get invested or be invested in. And that's what's key from your point of view. There's a question from Sharik also, JP.
Yeah, so I was just about to say that. So what are some good reasons to raise money and what are some bad reasons to raise money was the question. I'll tell you, it depends on the stage of where your business is, right? So if you're at the very, very early stage, nobody wants, other than maybe your family, nobody wants to give you a check personally that you're going to put in your pocket. If they write you $100,000, they want to actually put that capital to work, meaning maybe marketing, sales, product development. Really, it's outbound. Very early on, nobody's looking to be paying salaries. In fact, with almost all of my own companies and the founding team, none of us get paychecks. We're earning equity, sweat equity, to build the company. And then at an appropriate point in time with certain inflection points, then we'll start paying ourselves. Ideally, we are really incentivized purely because of the equity portion, and we can figure out how to manage our expenses on the side. A lot of entrepreneurs have moved back home, will go live with get a roommate, reduce your expenses to nothing. Maybe I've seen people who've been married, their one spouse has the job so they can make sure that the bills are being taken care of while the entrepreneur is taking nothing. So that's a pretty good sign from an investor standpoint that says, wow, this entrepreneur is really vested to make sure this thing works, because they're going to be using this money not to put in their pocket to take care of themselves, but to take care of the business. Now, that's only on the early stage. As the company is starting to grow and scale, you're looking at really the productivity of the capital. So early on, there's nothing to be productive. You're just trying to get it to work and proof of concept, get it to marketplace. But as you're scaling the business, people then look at it as a cash register. If I give you $1 million, how much do you expect to get me back in what time frame? If you can show them a history of invested capital in and rate of return and hitting metrics on the outside, then they're going to give you more, because they know that you know how to make money productive. At the end of the day, every entrepreneurial venture is an arbitrage of optimization, meaning you're able to take something and create more productivity and efficiency out of that investment than they could themselves in other deals. And that's really a perspective that you want to do. So they don't mind if you pay yourself a super high salary, as long as the net rate of return on their invested capital is faster and larger as time goes on. Victoria has a question. Do investors consider it is risky when entrepreneurs have full-time jobs? Mahavir, that's a great question. So the question is, do investors find it risky that the person who's starting the company is not working in the business, that they've got a full-time job elsewhere?
Victoria, forget full-time. Part-time employment, I wouldn't invest. Even if I got anything, the other thing I wanted to add was that as an investor, I have to see that you're invested in the company. You have nowhere else to go. You have no backup plan but the success of this company. If any question of mine, if any answer of yours, if anything tells me that you are doing this because you're trying to do this while you're in fourth year college, you ain't getting money from me. And for most of us, you have to understand. If you are not buying, forget your friends and family, as I said earlier. If you are not buying into the idea where you will be a multi-billionaire with this idea, why would I invest in you? So this is definitely a no-no. Don't even bring it up, and don't even bring this thought into your mind, because we will come to know sooner or later. Because, most of us are very, very, if we are inkling of doubts and we feel the team is good, the idea is good, we will not give you money in one go. We'll give tranches, we'll give you targets, you'll have to achieve. Any time on the roadmap we feel that follow-on round or follow-on money or bridge round or whatever you might want to call it is not going to come. So you have to really understand that this is a marriage or an adoption that you will not be able to leave unless you've put in everything that you've got as a team. That's very critical. And to add to what JP said on good money, bad money, of course, stage is important. Of course, multiple other things are important, but you have to understand it's for you to decide what is good and what is bad also. It's, while we are putting our, best intentions when we're investing, you also have to see, we've stopped investing when you're burning money unnecessarily on operations or on capital investment that you don't need. We would not pay salaries, as JP said. I would rather give you money where you're investing in R&D and creating value for your company. I would give you money if I could see that this is required to scale up. But the scaling up money is a diminishing money. It can't be a multiplier of the scale. If you go 2x, you need twice the money. It doesn't work. It has to be a diminishing requirement of money and validation at every stage. From one level to the other is very critical. That's why I would rather break my money in how I give you rather than give you all the money in one go.
Let me add on to that. So one of the, a corollary to this, and Hardik asked about what if you're in college, and I know that some of you are in college, some of you have jobs. We're not saying don't start a business when you're in college or when you have a job. What we're saying is if you're trying to raise capital from us and you're doing something else, I'm not going to give you money to go do something else while you're thinking about on the side building your business. So it's okay. I've been in the same situation. I was in college. I literally used the scholarship money that put me through Georgia Tech as my seed funding to go build my companies. In fact, I had 3 companies that failed, but I had no real major risk. I literally, out of the 21 different colleges that I applied to, the one that I picked was the one that was paying me and me not paying them. So net, at the time, college was way cheaper. It wasn't even that long ago. It was like, I was able to get an in-state tuition at Georgia Tech for $2,000 a year. So like that, which is relatively speaking, nothing. But I was able to actually apply for all these other scholarships, and they were able to literally net me cash flow rather than me going out of pocket. So I used college as basically my seed funding to go and build my first startups that didn't work. But Mahavir is beyond 100% correct. If I'm going to invest in a company, literal real dollars, why would I ever give it to somebody who's not actually 100% serious and focused on building that company? So definitely you want to be able to, it's not convince, you need to be dedicated to building your company. Now that may take you some time and years to get to the point where you can actually drop out and focus on it. In fact, I always try to say that I did technically drop out, but it took me 2.5 degrees to drop out of college. I literally stayed, I did computer science, then biomedical engineering, and I started another company. And as soon as it started working, I said, okay, finally I can drop out. So I dropped out of my 3rd degree. And the only reason why I stayed in school that long was literally cash flow for the businesses that I was trying to get started, because I didn't have the rich uncle that was going to write me $1 million check to go. And I had to learn, I used that time to learn and study all of these things. We didn't have business accelerators back then. We didn't have, the internet was just getting going. So that's the time that I used to study, to figure out, do mentoring programs. This is unbelievable with what we're able to give with TIE, but you've got to take that advantage and that time to invest in yourself so that by the time you're ready to go, that you've got your own master's degree in this discipline. Mahavir, any thoughts?
I totally agree with what you're saying. I absolutely love undergrads or postgrads starting a startup. What Victoria asked was something that, you're a part-time or a full-time working. There's nothing wrong in it. That stage of college, part-time, full-time working, and working on an idea, or doing research, market surveys, getting a prototype ready, you're okay. But once you want to scale up and you see that this idea will work and there's no competition, from then on, there's no looking. I should see that you will not go back to the work that you're doing. You should, I've invested in a company that was started by a second-year engineering student. He was so enthusiastic about what he was doing, he dropped out of college, and he's now valued at almost 90-some million, and he's an India-based company, which is a huge valuation for a company. And he was a simple hacker. It was an ethical hacker, JP. Now he is a full security company, and he's doing security for Make My Trip, for Naukri, whatever. And then now I've invested in 2 recent companies who are both 4th-year students who know what they're doing, they have revenues, they're already working on it, they're not doing bad in studies, and they're ready to graduate and go full-time into this. So it's just a balance that you have to strike. I have to be convinced that this is what you will do forever.
Yeah, one of the other questions here is what should the team be offered in building the startup from winning a competition to having an assembly line? I don't know the exact context of that, Sushant, but what I would say is whether you're winning a competition or not winning a competition, you are getting the advantage of simulating the process of going through a startup, right? So one of the things I always recommend is go be free labor in a startup. So I'm not saying just an internship for the semester. I'm saying go and be free labor for a startup. So if you've got, they always say this concept of your 5 minutes of fame or 15 minutes of fame. It's like a famous Andy Warhol quote. Well, successful entrepreneurs are a very small percentage, okay? But how many millions of people are trying to start businesses, fast growth ventures, right? The easiest way for you to circumvent the entire process is go find a successful entrepreneur who's starting a company, again, go be the executive assistant, the whatever they need to learn all these concepts. A great example is Jamie Dimon. Jamie Dimon is now currently the CEO and chairman of JP Morgan. Now, biggest bank in the entire world, assets under management, ridiculous, all this other stuff. So he literally dropped out of Harvard Business School to become the assistant of, gosh, what's his name? I can't remember, it just slipped my mind right now. Well, the point is that this guy was an awesome entrepreneur. He ended up building Citigroup, helped up scaling that company, did a whole bunch of other businesses. But the point is, he found out that he could become a free executive assistant for one of the most successful entrepreneurs in the entire world. Who wouldn't take that opportunity? And what you do is you have this approach of humility where you do everything. Guess what? I still clean the coffee cups if I'm in the office and there's dirty cups there. I still take out the trash if there's stuff that's laying around. I still clean the tables. You know what? If you don't have the ability to have that attitude, you'll never be successful. So you might as well find great entrepreneurs, and whether it's the Thai community or the greater community, spend time, mentor, support them where they need to, learn everything, soak it up. Because guess what? You won't have to make the same mistakes. Same example, going back to Kabir, he was able to go watch how AirWatch, the company, was being built, identify the problem, then literally get those same guys as mentors in the early stage. How much better of an experience can you get? It's okay that you don't have the experience. I didn't have the experience in my own industry till I learned it over time. But I'm telling you, if you get involved with fast growth companies with great leaders, the odds of your success exponentially increase, and you'll start being able to deal with a lot of these different problems and situations and get the experience and best practices up front rather than trying to learn through it the hard way with yourself. Learn on everybody else's failures so you can avoid the same mistakes. I can't tell you how to be successful, but I can tell you a lot of the mistakes that I've made, and Mahavir can, and Paul can, and all of us who are entrepreneurs in the Thai community can. And that's really the way I think that you should think about the problem. Sandy Weil is, thanks Paul for that note. Sandy Weil is, if you don't know about Sandy Weil and Jamie Dimon and that story, I really think it's an amazing story of humility, how you can serve someone, learn from the bottom, even if it's making a cup of coffee and being the chaiwala. That's how you can learn from the ground up as you're shaping your concept and framework for entrepreneurship. Mahavir, any thoughts or experiences that are similar?
Yeah, so I'll tell you from my own understanding, and I love this word attitude.
We can't hear you, Mahavir.
You can't hear me? Hello? Hello? You can't hear me?
We can hear you.
Okay. So I love this word attitude, and it has so many meanings in how you use it. And I have great attitude, and how you show that, you know, I can say, oh, this person has an attitude problem, and that attitude means differently. And what JP is referring to in learning and understanding and working with and having an attitude of a student is a different attitude. You know, you have to understand, you have to be the right mix of having the arrogance that you need for your idea or your startup. That comes from the confidence in what you believe in. And also having the attitude where you're trying to understand what an investor, what your mentor, what your teacher, what your guide, or what your team is telling you, to understand what their point of view is. Attitude is what will define your success. And I'm just being a little philosophical here. It's very, very critical that you understand that if you don't have the confidence on your team, you will not have the attitude to deliver that to your team, because you have so many people working under you. But if you don't have the ability to learn and understand from the mistakes of what others have made or what you are making or what your team can make, you will not succeed or grow the way you need to grow. So you have to have the right mix of the strength that an attitude brings, but also the humility that an attitude can bring to make a combination of a great entrepreneur. And that's what I have learned from you know, where I was. So when I listen to someone or when I meet someone for the first time, no matter what the age difference, no matter what the experience difference is, I'm always listening to him or her, and including, you know, all of you school, college going kids even, to see maybe I can learn something from them. And my questions are not in a situation where I'm trying to demean them. My questions are to let them understand what questions I'm asking for them to understand themselves better. And that's what it starts from. But once it's my domain, my sector, my expertise, then my tone, my attitude is totally different, and I'm trying to dominate a conversation and telling him or her where you're wrong because it's based on my experience. So from a student to a teacher, irrespective of what my or anyone's background is something critical that successful entrepreneurs have. And that's something that you all have to learn and understand: the psychology of the investor, psychology of your co-founder, psychology of the people working with you, and going forward in life. And that's the most important critical thing, I feel.
Perfect. So we're technically out of time. I'm going to stay on. I don't know, Mahavir, if you're able to stay on for a little bit more, but we want to open it up to questions. Paul or Amin, is there any administrative items? Great. So let me go through. So what are the questions that you guys have? Either you can raise your hand or type it in or ask right on the video. Sharik, you had a question? Go ahead.
In terms of our company, I've been working on it for around 3 years now. As you said, like the first 2 years of my third and fourth, my penultimate and ultimate year were just pure learning. And then after that, I was working full-time on the company post-graduation. One of the problems that we're facing is that we've gotten to the point where we've launched the product, we've tested it with users, we validated everything, won a bunch of competitions, all that stuff. The challenges that we have are with acquiring customers and reducing churn. And so my main concern is that, is this a valid reason to go and fundraise for?
So it's actually probably the hardest way to raise capital because typically you're raising capital as you continue to prove your model, not raising capital to prove your model. So typically your friends and family are willing to put complete at-risk capital and say, you know, try to go figure it out. But investors want consistent investors who are going to be doing a deal want to see that you're making consistent progress and hitting the milestones. And the capital is not to make you survive. The capital is to bridge the gap so that you're taking the company from this level to this level, not to solve the problem of, you know, surviving so that you can see if this is going to work. Now, people will invest in that phase when they won't invest a lot of money because it's super high risk. But in my opinion, you got to do everything you can to show that there's a market fit, that there's actually customers who are willing to pay, and that there's some consistency with that model. Now, it could be a few, and that there's investors that are interested at that phase. So as you phase up, as risk goes lower, you get better or cheaper and cheaper cost of capital over time. So at the very beginning, if you're trying to raise professional capital, one, I would not advise, if at all you can avoid, unless it's a heavy CapEx and you're trying to buy a lot of inventory and stuff like that, and that's where it is. Mahavir, any thoughts on that?
Totally agree. I mean, I think it's a very tough situation. Unless you have an IP-able product, unless there's technology that's not easily copyable, without customer acquisition, without growth on week on week and month on month, you will not get an investment from an angel for sure. It's not worth trying. It's not even worth you will have to acquire customers. You'll have to bootstrap. Even if you don't get funds from friends and family, your paid customers and growth on that number is very, very critical for you at any point of stage to get any sort of funding. If your idea is just unique in terms of what you're doing, or you're trying to do something differently and others can do it too. Virtually impossible, in my opinion.
Perfect. Next question.
Can I have a
Sharik,
very small
let's
follow-up?
go. Actually, Sharik, let's go around and then we'll come back to you, okay? Don't worry, I'm not going to leave. Who's next that'd like to ask a question?
Hello, sir.
Go ahead, Satish. Go for it.
Sir, would you try to, sir, which would you prefer, sir? Would you prefer people who have more talent, or people who have more hard work to invest in their business, sir?
The answer is both. I don't think I'd ever invest in a hardworking person that has no talents, nor would I ever invest in a person who's very talented that doesn't know how to do hard work. So at the same time, I think what you're saying is, do you have to have expertise of being a successful entrepreneur in order to raise capital? The answer is no, but it's a lot easier, I'll tell you, the 12th time around building a company to raise capital because you've had continued success, right? So you've got to meet your expectation from where you are and where your experience is. So if you're trying to get into, I remember one of my uncles, he owned what's called sawgrass business. It's the greatest, dumbest business ever. You're growing grass and you sell grass. I was like, this is amazing. He had, but he grew it from a small 1 acre property now to a 500-acre sod farm, which is huge. You can't even comprehend it. But the way he approached it is he wasn't the expert in grass, but he knew that people would spend a fortune on high quality grass. Okay. Depending on where in the world you are, this is not going to be a conversation or context at all. But by showing an investor that you have competency over time, that you can build a company carefully and show them, they're going to trust you a lot more. That's why I always get very dumbfounded whenever I meet somebody who has no experience, has never done anything, and is asking for a huge amount of cash. And I'm like, how in your mind are you wrapping around your head that with no background, no perspective, no expertise, that you're asking somebody to take a massive amount of risk? Whenever, you hear these glory stories of maybe Mark Zuckerberg being in the hoodie, walking into Excel Partners office and everybody being like, who is this kid? And then him getting a check for, I don't know, I can't remember exactly how many tens of millions. The reality was there was already tens of thousands of people on the platform with very high engagement metrics, right? You don't just magically get, remember, it's not about age. It has to do with consistency of track record, right? You're showing tangible performance. Now, if you don't have any of that, my opinion is start a business where you can show it. Start a business that's simple enough that shows that you know the principles of scale and that you can make capital productive. Do that and then go raise capital. If the odds are just going to be against you so much. I've gone through this process. I went through the process of starting another company where I was like, why isn't anybody wanting to invest in my business? Well, looking on the other side, the question was, I had no experience. I never built a company in this space. I had nobody on my team at that time that had any know-how of what they're doing. And I was just figuring it out. And I didn't even know how to make money with the business that I had. How can I expect someone to put their hard-earned money and investment into me thinking that I'm going to make it productive with no perspective at all? So that's why I always say, start businesses. Okay, so everybody has this adage, dream big. Fine. You dream at nighttime while you're sleeping. That's great. Go and dream. You can dream of whatever the heck you want. You can have a $10 trillion business for all I care. But the problem ends up being, and Paul taught me this, the most important thing is not your strategy. It's your execution. You can have the grandest strategy in the entire world. And I'm not saying that you shouldn't have a big strategy and big plan. But if you cannot execute the small things consistently, that's actually how you build a company. And whenever you're raising capital, it's the same way. I never have been frustrated taking at the beginning of a company a $5,000 check, a $1,000 check. Why? Because even though I've built successful companies in the past, I have the humility to recognize that I'm back at square one and I'm going to build trust over time. So I raise the capital from people that trust me initially and then slowly raise the capital over time. Yes, I'd love to get $10 million checks every time I go knock on a door, but yes, and every once in a while I will. But the reality is I'm still okay with raising smaller checks over time, showing performance, building relationships, and showing that over a period of time. Mahavir, any thoughts or perspectives?
No, I think you've covered it all. Great, cheers.
Perfect. Any other questions? What else?
So I have a question a little bit different from investing. So personally, I feel like we are really too early for like big capital investment. Like I know that, but one of the things that we would really like would be like a company partnership kind of thing, so that we could have more people just to like help, prototype and like develop. And also just get more resources from another company. So my question is I know this could be a whole nother class, but in a short sentence, how similar or different would looking to invest or looking to partner with a existing company be than like looking for capital investment?
JP, and I was going to say that to the previous question also. Victoria, in your situation, you need to find a partner who would invest in the prototype, who would invest in looking at how that can fit the current industry. And if, let's say, that requires 100,000, 500,000, $1 million, whatever needs to be invested into that, what you and your teammates, the co-founders, need to say, we will give you 50% of the equity. You put in the money. We work for free for a year. And we create this product, whether part-time or full-time, and we will not take any money, and you put money as we go along. The IP, the patent, whatever we create in this 6 months is yours if we don't succeed. If we succeed, then we split it 50-50, 60-40, 30-70, whatever that may be, depending on how many of you are there and what the technology is and how innovative it is, or how much money is required to deliver that. If the money is more, his share goes more. If the innovation is more, your share goes more. And you have people like within the Thai fraternity who could tell you what role the money has to play, what role the innovation has to play, and what role has the time of your qualified as your teammates have to pay. And that's what's going to determine a partnership. And that's one way to go forward for people who are not able to raise money. And that goes for Sharik also in the previous situation where he obviously needs money to acquire customers and he cannot do that. So you should go to someone who's in that sector, who's in that domain, or who has those customers that work for you, and give them a major share and work for free for your share of equity. See, you have to understand your 90% equity that you hold, or 80% or 50% is as good as the success that you have. You know, so if you can't succeed without a good investor, or you can't succeed without a good partner, or you can't succeed with a company that has the customers that you need. So if it's Chevrolet or Tesla or BMW for your company, or for whatever Sharik's companies or domain leaders are, your idea is worthless. Your product is worthless. So understand who's bringing what, and that might help you go forward. I mean, I've done that. I've done that in real life. You know, I have people working with me. I've given them equity. I put in all the money because they have the ability to deliver that I don't have the ability or the time to deliver. So that's what's key. That's what all of you are bringing as college grads, as people who are working for a year or two. Think on those lines also. Just don't go for 5, 10, 15% equity in angel rounds, because that might not work in many cases. Think out of the box while you're looking for money also.
Yeah, I think Mahavir, you know, I think that's very well spoken. Victoria, it's a great question because, so I've done this a lot and I do these kind of strategic partnerships fairly consistently. So what I wrote here as a note to myself is you want to find what are called easy strategic partners. So you are piggybacking off of their infrastructure. They almost have to do barely anything. And then what you're doing, like Mahavir said, is creating value off of their architecture, whatever that is. So for example, I had a friend of mine who knew that I had this entire software architecture for, you know, doing consumer lending. Really, they were looking at the credit modeling aspect of it. And they said, hey, could I partner with you to pipe in that data, combine it with some Equifax data, and sell that as a product to businesses? And I said, well, that's a no-brainer. Literally, I have to do nothing other than maybe set up some portal infrastructure so that you can sell this. So we set up that infrastructure and they started selling it. We went down the road. I think we put 40, 50,000 to get it up running, branded, whatever. But it took really no effort from our team to empower that person. And it was exactly what Mahavir said. It was a 50-50 split, and any additional capital that we put in was additional equity that would have to get paid back to us in advance. And part of it worked, part of it didn't, but that's how it was able to do a strategic partnership. Now, here's the thing. If you're working with big companies, good luck. Now, there are some companies that have incubation labs and innovation centers. Those are the ones that you want to partner with. And even that, then it's kind of a feel good. Who you really want is to talk to the founding team or founding owners. Talking to the CEO of a publicly traded company sounds like a good idea, if and only if they're like a founder. Really, you want the entrepreneurial energy of the company to empower you to create a strategic partnership successfully, not an executive. It is the last thing on their plate. They do not want to put any energy, effort into it. They pretty much don't want to put any money into it. God forbid you talk to a CFO or the finance team, they'll be like, really no opportunity here. What you want is the entrepreneurs within the organization that have their own budgets, that can write the check and say, go. Those are the strategic partnerships that end up winning. And I know it sounds crazy, but even if it's like Elon Musk and you want to do a partnership, you can do it. You got to build the relationships to get, and you can get there. I mean, I remember this kid who was in middle school who raised $2.5 million from Li Ka-shing, who was one of the wealthiest of all time. But why the heck would one of the most successful investors of all time want to invest? I think it was called Sumly. I don't even know if the app exists anymore. But the thing is, you got to talk to entrepreneurial investors, in my opinion. Now, Vinod Khosla, who's been a multi-time speaker at TIE and has a good relationship, he has this one talk that you could probably find that he was teaching at Stanford, where he hates VCs. He hates VCs who are just investors. He loves entrepreneurial investors. And those are what we are, which is we can empathize with your plight. We can empathize with the struggles that you are going through because we've gone through it ourselves. I can tell you, a professional VC firm, nowadays, I mean, yeah, you might get a good deal, but if they don't understand what the experience is of being an entrepreneur, I would be very cautious on the terms that you're signing on. Because if they don't empathize with the struggle and the ups and the downs, the lefts and the rights, they will have rights and provisions, like we talked about on that last slide on that third column. If you don't know those terms, they're going to force it on you. You don't really have a choice. And one of my friends built a company, got fired from his own company from the VC firm. They brought in another CEO. He still was stuck because he had all the equity there. That CEO started failing. They brought him back in, and he ended up actually selling the company for over $1 billion. But I am telling you, the last thing you want to experience is working with a VC fund that really doesn't have your interests at best hand. Just like Mahavir said, end of the day, they're looking out for their money and their investors' money. They really don't care as much about you if you are going to prevent them from making sure that that money is going to be safe and grow. So you have to be very careful, even with strategic partnerships. There is this dumb, fun movie that I just watched called Ford versus Ferrari. If you haven't seen it, it's a really fun movie. But I am telling you that that entire storyline is not about why they were successful with the Ford GT and the F1 series. It was everything that was against them with executives doing a strategic partnership with a large Fortune 500 company of the politics, the playing that game. When you're dealing with larger companies, there are a lot of other people in that organization that are vying for those dollars and attention. And you really have to understand that when you get in bed with an organization, it could bring you down. For example, IBM bought a friend of mine's company called ISS, which is one of the most successful companies here in Atlanta, multi-billion-dollar exit. They IPO'd, then they got acquired by IBM. IBM basically suffocated that company to death, and there is 0 people in that business anymore. That happens all the time. I'm sure Paul can tell you, having been at IBM, and those of us who've worked with companies that are large companies, I'm telling you, you get that check as the owner, and that company is strategically now part of that other business. The odds of it ever surviving are so low, it's not even, you can't even count the number of companies that have worked out. The ones that worked out, though, are the ones that you're working from an entrepreneur to entrepreneur perspective. That there's a meeting of minds, that we're there, that the strategic partnership is there to support you, not control you. The moment that switches roles, it's going to be the death of any innovation in entrepreneurship. What other questions?
I have a question, James.
Go ahead, Sushant.
Yeah, so combining both free labor and strategic partnership, I have a question regarding my previous question itself. So if I'm looking to hire a high qualified MBA who is in a paying job, so can I offer him equity in return for free service till for a year or 2?
Well, I don't know about 2 years. I don't know about 2 years, but the answer is always yes. I mean, people are astounded. I mean, Paul can tell you, having worked with me in this latest company and being on my board and one of my investors as well, I was able to convince people who had literally decades of specific industry experience to come on board for free for like 6 months with literally Kabir said the same thing, with I didn't even structure the equity comp. What we call it was an extended dating period, which is They got to experience how I ran the company in leadership, and there was trust and rapport, and I got to experience their work ethic and their ability to execute. Now, yes, they're now very highly well compensated, but they took a lot of risk, and we built a structure to make sure we rewarded them for that. Now, I know there's crazy structures, but maybe Mahavir, and I can chime in after, what are some of the structures that you've seen that when you're building that founding team to incentivize people who are experts that are not going to get paid, and how do you go through that process, and maybe talk about equity option pools, et cetera?
Yeah. So I think zero paid would not work. And it should not be the case, because that means that person would not put his blood and sweat into what your thought process is. I think they need to get the basics covered, but they should be incentivized. And ESOPs are always the best thing to do going forward. Even upfront equity or a title of a co-founder, despite it being your idea, despite you having worked on it for 6 months to 8 months. All these titles in India are pretty common. They are, I mean, I've had companies that are 5 years old. Someone comes to be called as a co-founder of the company in itself is value to that person. So I think there are multiple ways to do it, but a lot depends on what you are thinking of, what the company is, what the idea is, who the person is, how much he or she has been working for, what is he bringing, or he or she is bringing on the table? Is he or she able to work for a minimum amount of money? Are you good enough to have sold the idea to that person or not? Multiple elements take a role, but it's a doable road to take.
One other thing I would suggest is, I mean, it's a pretty competitive marketplace, but AngelList is a place where you can actually post job opportunities of getting co-founders. Kabir actually, when he was getting his co-founders, used AngelList, posted jobs. If you've got great VC partners, they will introduce you to an awesome executive team. And like I said, it's a dating process. So we'll use that. I don't know if that TV show Indian Matchmaking is literally all over the world or just in the US and everybody's watching it too much. But, you know, if you're going through an arranged marriage process, right? My brother got an arranged marriage. You're meeting a lot of people. You're spending a little bit of time with each one of them. And you're going to see if there's a relationship because of background, perspectives, values, culture. All these things are very, very similar in the initial process with that team. And that's literally what I'm looking for when I'm bringing initial team members together. And actually, one of my co-founders was an audience member at a Thai event that I ended up bringing on board. And he's now in senior leadership and a major partner. And in our own company, we did exactly what Mahavir said. We've actually set up a structure for people who've been for a long time. They didn't get compensated as much as they market was. They got more equity. And those people who are coming in newer get less equity because we're paying them more and they're taking on less risk. So they're earning more equity over time. And it keeps people incentivized to stay sharp, be motivated, be excited. There's a carrot down the road that they're going to be able to get from that standpoint. Great question. What other questions? I'm going to have to leave in 15 minutes, but any other questions out there? I know you've got a bunch. Go ahead, Akash. Did you raise your hand?
I have one question for Mahavir sir. How does the Indian VC mindsets differ from what is there in abroad? Is there some difference or is it all the same? Because we have not seen many hardware startups in India. That's the reason I'm asking.
No. So there are many I've invested my first few investments I made. I've invested in a hardware startup. It's not that there are not many hardware startups. So the pro rata basis investments happen from what they have. But I'll tell you, there's no difference. I mean, JP and I did not rehearse this. I mean, he just shared the PowerPoint with me. I just read it. I didn't even comment on it. And I said, I'll just go with the flow, because we're speaking from experience. We're speaking from what we know. And there's absolutely no disconnect. I don't think anything that I've said or he's said that we disagree on. And because it's absolutely the fact that we are sharing what we live with. So I don't think there's any difference. It's just that valuation and not knowing the market. So if there's a US-based startup which is going to the US market, I might not have an idea of the US market or the US competition. JP might have that, and vice versa for India. Because I'm not investing in US startups, so I don't read about them. And same for JP. So that's the only difference. We're not understanding the market as much as each of us do. And so the valuation might vary. Otherwise, approach, process, questions, yes, no, more or less the same.
Yeah, I'll tell you, from raising hundreds of millions in Germany, London, India, Taipei, and Taiwan, in South Korea. Can you please mute yourself, Arun? So when you're going through that process globally, you just got to be professional. And what I mean by that is you got to get recognized law firms. You got to do a little bit of extra steps to validate who you are, what your background is, what the data is it reliable? And the way you do that very easily, all these structures are fairly standard, but whenever I'm doing international investments or vice versa, I'm raising capital internationally, it's, do they have a large recognizable law firm? Do they have a large recognized accounting firm, audit firm? What are the procedures and protocols in that country, in that locale? So that actually, again, I know I'm beating that dead horse. Thai is the ultimate solution to that problem. So for example, if I've been to Jaipur, but I don't live in Jaipur. If I'm going to do a deal, I'm not going to be calling Paul and say, hey, what do you think about this deal in Jaipur? I'm going to call Mahavir. Or I'm going to ask and reach out to the Thai community and say, hey, I'm looking at a deal in Tokyo. I'm looking at a deal in Israel. I'm looking at a deal in Germany. I'm trying to raise capital in Germany, wherever the marketplace is. The ability for you to spend time and build relationships at this phase of where you are in this age, with the world being completely virtual, this is the greatest opportunity, in my opinion, in history to accelerate the process of relationship building and utilizing these networks like Thai to really hone in. But I would agree with Mahavir. I personally have had, you want to keep things vanilla, meaning common structures that are universal globally and globally recognized. And everybody knows, and that's how those deals get done. And they get done pretty quickly because you're using traditional protocols that's accepted globally. So things like accounting practices using GAAP, a lot of those items are pretty standard. So Mahavir, thanks so much for your time. Definitely, you can also connect with me on LinkedIn as well. Any final thoughts, or all good? Perfect. Thanks, Mahavir. Take care. And I'll be on for 11 more minutes. You can definitely click to his LinkedIn. And if mine's easy, just type in JP James. What other questions? Sharik, you want to ask that question again that you were going to follow up on?
Yeah, sorry, I had my headphones off. I literally took my headphones off for 5 seconds and you called me in those 5 seconds. But my follow-on question was, what are your thoughts on investments that are done pre-product or pre-revenue? Because I do know that those exist.
They do. To be frank, they exist for people who are already experts and recognized. So for example, literally if I wanted to start pretty much any single company that I could possibly come out of my head, and I don't even have to have a concept, I literally could text anybody that I know and they just wire me money. Why? I could probably raise 10 million with my eyes closed texting people that I know. Why? Because they've already invested in me, they've already seen my track record, and they've already made money with me, right? So yes, there are seed professional investors, and there's a lot of it. But the reality of it is it's because they know you and they've seen your track record, and you've built that over time. For example, I always give the analogy, if if you knew for certain that you were going to be worth $100 million in 10 years, but you had to go through pain, suffering, and basically abject poverty, and barely making ends meet, you're not eating well, your relationships are struggling, but you really are super passionate about building a company. If you knew it was going to take 10 years, but you're going to get a $100 million paycheck, you'd be like, okay, either I could spend the rest of my life suffering in my job or whatever, or suffer for 10 years and then make the hit at the end, right? That's literally got to be your attitude when you're going through this process. And seed capital, just if you don't have experience, you can try, but that goes back to friends and family. You're literally begging money from people who just are like, okay, here's a handout. I've got to spare, $500 or $100 or, whatever your currency is. I'm going to give you that amount of money because it's not really high risk. And that's how you raise seed money. In fact, Paul can tell you, I was actually personally guaranteeing the initial investments of several of our investors the first year. And that's because, actually a lot of people are like, I don't need the personal guarantee. I want a higher rate of return. Well, in fact, I use that as a negotiating tool where I actually paid less interest on some debt financing that I got because I gave a personal guarantee that no matter what happens in this business, I will pay you back. And that's because they know, they believe in me, and that worst case scenario, I'm going to be able to figure out something. One of my friends, he started a company and he raised several $1 million and it went under. And he told everybody, here's your option. Either I will pay you 100% dollar for dollar every single penny that you invested in me, or I will take your amount of money that you got in the new business that I'm thinking about starting. I will give you the pro rata portion of equity. Now, I'm sure you know what I'm going to tell you is the end of the story. So there is a lot of people that said, I'll just get my money back and I want a payment plan. And they got their money back. The people who rolled in, one of those guys put $100,000 on the first deal. It failed. They rolled that $100,000 into the new business. It's worth $66 million on a publicly traded company now. And that's the type of people that you want to bring onto your company as an investor. So I have this thing that one of my investors told me. He said, SNAP policy. This is a little bit crude, but it's strictly no asshole policy. The reason why it resonated with me, and we've taken that approach, is you are going to go through tough times. Period. There's no such thing as a startup that just goes straight up and never goes down and never goes sideways. So the people that you are bringing on board, the best day of your relationship is at the beginning whenever you sign on the dotted line and they sign on the dotted line. So if they're already causing troubles at the very beginning, you do not want to take their money. We had one, I remember whenever I was starting one of my other companies, my hedge fund, and this guy, it was the very beginning of the company. He literally, the term sheet was $10 million to get the company going. And we were like, wow. I mean, we haven't even started this business. And this guy is really excited to give us money. We weren't seasoned. We had a couple people had experience. And one of our brokers had called me and said, hey, I heard you're talking to Earl. Don't take his money. I was like, dude, we're just starting this business. This guy is writing us a check for $10 million. What do you mean don't take his money? Well, he told me in like a few seconds, he said, this guy has sued 5 other hedge funds as he's invested in their business. I was like, okay, done. Not even touching. I never want to even talk to the person ever again. So there's 2 sides to this equation. You need to do due diligence on your investors. And Kabir made a good point yesterday where he said, if you have to take the money from the investor, you're in a bad situation. You want to be in the situation where you don't need the money. So when you negotiate, you've got great terms. I remember Paul and I sat down very early in 2017, and he said to me, how much money do you want to raise? And he said, at what valuation do you want to do it at? And what do you think is a fair valuation? And we put the numbers together, and I said, I'm concerned. I don't know if, I don't know if I'm going to be able to raise this capital in this time frame. I think Paul is probably rolling on the ground laughing. Beyond it being a team effort, I mean, I think we were targeting like $2 million within the first year that we wanted to raise, and that would get us up running and scaling the business. I mean, almost $30 million later, it's almost laughable to do that. But the biggest thing is you've got to have integrity. And I'm telling you, the values and the culture and the transparency that you have builds the relationship at the early days, because the investors you're getting, they're really investing in you. They're not investing in the business. They're not investing in the financials. Yes, they want to have a great opportunity, but they need to believe that you're the person that they want to bet on. And you treat them well, you give them a great return. They become your fanatical advocates. Because, and I'll tell you, we have this thing called network effect whenever it comes to our raising capital. And Paul can tell you as well. You build these relationships, and those relationships build relationships for you as an advocate. But that advocacy comes through time, because you're showing performance, you're showing transparency, you're showing consistency, you're showing the numbers when it's not working and when it's working. And they become they raise all the capital for you. I would say, I think there's like 4 networks, including one of Paul's funds, that have been what I call these network effects that have raised us millions upon millions of dollars. Why? Because we provide the consistency and transparency and are available to our investors. And on our side, we're not working with investors that we don't want to work with. We're not taking money just because we have to take money. We take money from people that we want to take money from, and vice versa. So we have a relationship as opposed to an adversarial relationship. So that's a critical component. I got 2 minutes left. Any other final questions?
Not a question, but just a comment. Several of these people are going to be available. We're going to give you all scholarship membership to TiECon Atlanta, because you've been participating at TiE University, and you now have access to TiECon Silicon Valley, TiE Atlanta's TiECon. So we appreciate you all staying on and participating. So use the network, as JP said. So
yeah, as a closing comment to follow on with Paul, you know who the mentors are. There's a reason why we're mentoring and we're giving back. It's because we love giving back and mentoring. Those are the people you want to start with. You've got a huge list of mentors globally, all various backgrounds. Now, not everybody is going to connect the dots. So for example, if Hardik, you want to have me as an investor in your company, it may not be a fit, but that's why you provide communication, provide consistency, and you do it periodically. I build relationships systematically. Now, that sounds like an oxymoron, but whenever you put on the calendar that you're going to meet up with every one of your investors every single quarter, put FaceTime in, have conversations, see how their family's doing, and you do it on a consistent basis with all the mentors at TiE, yes, it is a lot of work. But tens of hundreds of millions of dollars later, nobody's really complaining. The point is that there is a return for it. They always say, things like golf or different types of activities can help you build a relationship, create ecosystems. You don't have to foot the bill for everything. Have your investors foot the bill, but do things that are fun. It could be online events. We're doing different types of programming online with our investors because we can't meet with them in person. Be involved with their charities, their nonprofits, support them where they want to be supported. And that's how you build that relationship. It's not about you, it's about you guys being together from that standpoint. Well, thanks everybody so much for your time. I love giving back. Paul knows that. And here to help answer any questions in the future.
Thank you so much.
Later.